The IRS has a surprising amount of freedom when it comes to collecting delinquent income taxes. Not only are they able to garnish wages without a court order, they can also withdraw funds from your bank accounts. This is called a bank levy. If you don't have enough funds in your account to pay delinquent taxes in full, the IRS may take further action, such as putting a lien on your home or seizing your assets. Fortunately, the IRS makes earnest efforts to contact you before resorting to this aggressive collection action. The IRS will mail notices to the last address they have on file for you in hopes that you'll contact them to settle your delinquent balance. If several notices go unanswered, a final notice of levy will be sent to you by certified mail. If payment arrangements aren't made with the IRS within 30 days from the date of the final notice, they'll move forward with the bank levy. The IRS notifies your bank of the levy, and your banking institution must freeze the funds in your account for 21 days. During these 21 days, you nor the IRS will have access to the funds. If the bank receives no further notice from the IRS, the funds will be distributed to them, and the IRS will apply them to your delinquent tax debt. During the 21-day period, the taxpayer has a final opportunity to reach out to the IRS to establish a payment agreement. If this is done successfully before the 22nd day, a release on the levy may be attainable in some cases. This means the banking institution will remove the freeze and you'll have access to your funds again. You may request the freeze removal by contacting the IRS yourself. However, many taxpayers opt to hire a tax relief professional for a better chance of regaining access to their funds. If you're able to regain access to your funds, be patient. The process can take a few days. After the IRS has frozen your funds, any deposits made to your account won't be subject to another levy. The best way to protect your bank account from an IRS levy is to prevent it in the first place. Sounds cliche, right? Even so, there's no protection for these funds once they've been frozen, and the IRS often applies them to your back tax debt, even if a payment arrangement is made after it occurred. Once a final notice has been generated, you have 30 days to respond before action is taken. Here are some effective response options. Pay the delinquent tax debt in full by sending a check, money order, credit card, or debit card payment to the U.S. Treasury. As this option isn't readily available for many taxpayers, there are other payment options. Are you able to borrow money from a family member or charge it to a credit card? Some taxpayers opt to liquidate an asset to cover their back tax balance. If these options aren't within your reach, consider contacting the IRS and establishing an installment agreement. An installment agreement allows you to make flat payments on the debt every month until the debt is paid in full. But remember, during the installment agreement period, interest continues to accrue on the delinquent debt. If you're experiencing a financial hardship and these options aren't feasible for you, the IRS will examine your circumstances and may release the levy so that the bank can make your funds available to you again. You'll need to provide them with documentation that proves you'll be unable to cover monthly living expenses without the frozen funds. If the IRS determines that you can't afford to comply with any collection efforts, they may cease them until you're back on your feet. Consult a tax professional for detailed information about your financial situation if you're not sure which option is best for you. Their education and experience allow them to determine the option that serves your best interest and properly execute it. Check out our blog for more information about responding to bank levies or wage garnishments.